So the first quarter of this year started off with some weakness in US equity markets, while the rest of the world was holding up relatively well. So we know, of course, in the first couple of months of the year, Canada and Mexico were sort of the focus of the US administration's trade war. And in the meantime, European markets, Asian markets actually held up relatively well. You also had a little underlying theme of emerging strength in Chinese AI, which was drawing some flows away from the US as well. Of course, things changed quite dramatically in the first few days of April. And as we sit here today, with those reciprocal tariffs that were announced in early April, which of course were not quite reciprocal whatsoever, but certainly a lot higher tariff levels on a wide range of countries around the world, much higher than what was expected by the market. We've seen markets falling significantly in these early days. Now, international markets still holding up better on a year-to-date basis, but the selling at this point, fairly indiscriminate. How does this compare to other environments? It's a great question. One of the things that's clearly very different, and one of the things that I think that has markets a little bit spooked, is going back to the great financial crisis back in 2008. Every sort of bear market scenario we've had policymakers, again, whether on the monetary side or the fiscal side, have typically been there as a backstop, trying to come in and support the market in times of stress. In this scenario, we actually have the government, the federal government in the US, actually driving a source of volatility, right? So a little bit of a self-inflicted wound certainly creates some different dynamics, but in certain cases, and we'll talk a little bit more about, volatility in many ways creates very similar environments for investors to deal with. So looking at how things have played out so far this year, traditional asset class diversification has been working pretty well. So high quality bonds on the fixed income side of your portfolio have been providing a little bit of an offset against the risk in equity markets. So when there's growth concerns, bond yields typically fall and bond prices rise. So that traditional relationship between equities and bonds has been beneficial so far this year, and certainly in these first few days of April, where volatility has been certainly very high in equity markets, bonds have provided some stability. At the same time, when we look at the year as a whole, global diversification has worked well at the same time. So US equity markets down significantly, tipping towards bear market territory as we record this video. International markets holding up relatively better. So markets outside of the US. And we think that's something that may persist. Certainly the situation is very fluid, but I expect as the US has chosen to initiate a trade war essentially against the rest of the world, incrementally, I do think more and more investors and more capital will begin to flow to opportunities outside of the US, which should help support international markets. Other areas of strength certainly would point to gold. So far this year has held up quite well. So the precious metal has served as a useful offset against some of the policy uncertainty that we've seen so far this year. So in recent days, we have reduced risk within the portfolios. A few of the long tactical positions that we've had to be overweight equities in the closing days of March, we've actually taken those positions off, actually reduced to a slight underweight position in equities, purely from a risk management perspective. We maintain an overweight position in gold, which is, continues to act as a good hedge against policy uncertainty. And more importantly, we continue to rely on our very well diversified strategic underpinning. So having those strong, high quality bonds in the portfolio to hedge against any growth concerns around all of this uncertainty with policy, with trade, at the same time being well diversified across geographies, across real assets and alternatives as well. Again, providing some areas of stability and relative performance compared to others that may have more of a difficulty within this current environment. So volatile periods, and certainly coming out of periods with very large drawdowns, active management, the ability for skilled managers to select between high quality, attractive companies and those that may be a little bit more exposed to the risks of the day becomes quite important. When we've gone through a sell-off, as certainly is unfolding today, the opportunity is even more apparent to those active managers, right? The so-called baby getting thrown out with the bathwater. You have relative opportunities where the actual prices may dislocate from fundamentals. There are some companies that could be more resilient, for example, to this emerging new economy where global trade is perhaps not so freely flowing. A good, strong active manager can take advantage of those opportunities, and we expect active management to truly be a source of resilience for the portfolios going forward.